We can catch up now with the former St. Louis Fed President, Jim Bullard, for more. Jim, welcome back to the program, sir. So much has taken place since this election. We've heard from the chairman, Jay Powell. Jay Powell suggesting to us that maybe they can pause if they want to. This is me inferring from what he's told us already, maybe as soon as December. Is that what you're taking away from recent communication?
Yeah, I mean, if it was me, I think they could make one more move here in December, and then that would put them at 4 3/8. And then there'll be a debate about where neutral is. But if you thought the median of the committee thinks neutral is maybe 3%, then you have to have maybe 100 basis points on top of that, because, or 125 even, because inflation isn't all the way back down to target. So normally you would take the inflation difference and then multiply that by 1.25 or 1.5 or something like that. And that's what a Taylor rule would do. That's going to put you right around 4%. So they'd actually be pretty close to where they'd want to be. They'd have another move to make maybe in the first quarter or second quarter. And then after that, it would depend on where inflation went during 2025. So they're in pretty good shape here, I think, for the December meeting.
Jim, maybe for December, but moving beyond that, there's a real question. I haven't heard a lot about long and variable lags in a long time. And basically, there's this feeling that maybe if markets are flying and we have this feeling that businesses are doing just fine, that everything can chug along at these interest rates. And you alluded to it. We could see a higher neutral rate. Just how much have you heard a change in tone from Fed officials over the past couple of weeks?
Yeah, well, they've made 75 basis points of cuts already, so they're not in the same situation that they were in, say, June or July. And I think the growth scare that occurred in sort of the July-August timeframe has dissipated, and now you've got GDP now, Atlanta Fed at 2.5, and the last 2 quarters of growth have been pretty strong, certainly above potential growth rate for the U.S. economy. And so I think, they don't have to go too much further to be at the right rate for this level of inflation and an economy that's, moving along pretty well. Retail sales, reasonably good yesterday.
So given all of that, I'm trying to extrapolate this out to understand what this means at the long end, what this means for the yield curve at a time when suddenly people are rethinking just how much they can cut over a longer period of time. You add to this some of the pro-growth policies that we've been talking about all morning. How much are you looking at bond yields resetting, not necessarily because of the political overlay, but because people are realizing that if it's a 4% neutral rate, a 5% 10-year yield looks pretty reasonable?
Yeah, I mean, to me, this is the last piece of the soft landing. You're bringing the policy rate down to a more neutral level as inflation goes back to target, and you would expect the yield curve to uninvert, which has happened here. And I thought that, eventually you'd have the policy rate somewhere in the 3s and the 10-year somewhere in the 4s, and you'd have this nice upward sloping yield curve. So that all seems to be developing. And that's part of the soft landing narrative, in my view.
When we heard from Jay Powell and the fact that he's talking about they're not in a hurry, how much does that have to do with policy uncertainty that right now is coming out of Mar-a-Lago but will be coming out of Washington, D.C. for 2025?
Yeah, I think the sense of not being in a hurry, if you think about this December meeting that's coming up, there'll be a summary of economic projections at that meeting. And what the committee will do is various members will project out for 2025 and 2026 how many more rate cuts they think. But it's not going to be that many, right? Because they've already made some, and neutral won't be as far away as it was. And so then they'll say, well, some people say I only need 2 more, or other people say I need 4 more or something, but they'll spread those out over 2025 and maybe even over 2026 as inflation is projected to continue to come down. So in that sense, it will smooth out, and people start talking about, well, maybe once a quarter, maybe once every third meeting or something like that would be the right pace, depending on how fast you think inflation is actually going to go down to 2%.
Right. So you're talking about inflation coming down to 2%, but some of these policies could be inflationary. We're talking about deregulation. We're talking about cutting taxes. And then there's this debate on how high the walls are going to go up around the United States for imports coming from China or the European Union. If that's the scenario we have, does the Fed need to think about potentially hiking?
You know, I think we've seen this movie before in 2018, 2019. I didn't see much inflation coming from that. We had a corporate tax cut late 2017. I didn't see much inflation from that. So I don't think that that's the right narrative for this. You know, that's not where the inflation is going to come from. Where it comes from is big fiscal spending, but if it goes straight into people's bank accounts the way it did in 2021, that's almost like printing money, and that ended up causing a lot of inflation. But if we don't get something like that, and I haven't heard anybody talking about that, then I think other types of spending are probably not, deficit spending, probably not as inflationary.
Jim, that's a fascinating point, and it really goes to the heart of something that I've seen explored in a number of research papers over the past few weeks, which is how we don't understand inflation, why the Fed got it wrong and didn't raise rates as early as March of 2022 in the face of real inflation, and going forward our understanding of what the read-through will be from things like tariffs. Are you basically saying that some of the tariffs that we're hearing about are not going to be inflationary, and that frankly we should be looking simply at a cash infusion, helicopter money, as the only source right now of the inflation that we've seen in the post-pandemic era?
I mean, inflation is a monetary phenomenon. That's why they call it monetary policy. And it's the job of the Fed, especially, to keep inflation expectations under control. So you could argue about an inflation expectations channel here. If people start to worry that the Fed's not going to do its job, that would be a serious concern, I think, for the inflation outlook. But tariffs themselves, kind of a double-edged sword. They rearrange the prices somewhat, but they also change demand for the imported good, and you've also got what's the reaction of the foreign country going to be. So a good outcome would be is that you get serious here and you tell the rest of the world, which is pretty protectionist, you tell the rest of the world, you know, the U.S. is going to play tougher here and we want you guys to lower your tariffs. And those guys could say, hey, well, you know, we agree and we're going to lower our tariffs. So you get just a lower tariff environment out of the whole thing. That would be very consistent with sort of the Trump negotiating sort of view of the world.
Jim, we won't ask you for your favourite Trump Treasury Secretary. We'll let you go. Former St. Louis Fed President Jim Bullard. Jim, appreciate your time, sir. Thank you.